On the surface, corporate debt markets appear remarkably unfazed by global pressures. But this calm is a mirage. Default risk is at its highest since the global financial crisis. This isn't theory. In 2025, a staggering $42 billion in corporate bonds were downgraded to junk. This new reality demands more than standard accounts receivable. It requires a strategic overhaul. We'll dissect these risks and reveal the strategies, from AI to psychology, for financial resilience. So how big is the problem on the horizon? A tidal wave of debt is about to hit the shore. Over $1.5 trillion in U.S. commercial real estate debt will mature by the end of 2026. In this environment, every single day matters. The value of an unpaid invoice is in constant decay. How fast does it decay? After just 12 months, the likelihood of collecting that debt plummets to a mere 10%. Let that sink in. 90% of that receivables value can vanish in 1 year. Early intervention is non-negotiable. With the clock ticking this aggressively, where can you find an advantage? The answer is in technology. Companies are already voting with their budgets. The debt collection software market is set to pass $5.3 billion in 2025. This is not just automation. It's about intelligence. Modern systems use data analytics to segment debtors and tailor the approach. The most powerful tool is predictive analytics. It forecasts who will pay, who needs a nudge, and the best strategy for each account. This moves your team from a reactive, one-size-fits-all model to a proactive, data-driven strategy allocating resources for max impact. It all sounds good in theory, but can this technology truly move the needle on recovery rates? The answer is an emphatic yes. The results are not just incremental. They are transformative. AI and predictive analytics have been shown to increase debt recoveries by up to 20%. It also makes your team faster and cheaper. Collectors can handle significantly more cases with these tools. This proves proactive debt management, powered by data, is vastly more cost-effective than waiting for delinquency. Technology is a powerful weapon, but the next vital decision is who wields it. This brings us to one of the most pressing strategic choices: keeping collections in-house or outsourcing to a third-party agency. The case for in-house is about control. You dictate the tone, protect the brand, and can preserve valuable customer relationships. The case for outsourcing is about results and specialization. Professional agencies often have higher recovery rates from their singular focus. There's also a frequently overlooked benefit to outsourcing. It's a legal shield. Agencies manage complex laws, reducing your liability. The right answer isn't universal. It's a strategic trade-off between control, cost, recovery rate, and risk. But whether your team is internal or external, the question remains. Beyond structure, what specific tactics work in the trenches? This is where data meets dialogue. Remember how analytics segments debtors? That data becomes potent with a technique called tactical empathy. It's not about being soft. It is about being effective. By listening and validating a debtor's position, you build trust and find realistic plans. This mindset extends to the full debt lifecycle. Restructuring isn't failure. It can be an intelligent move for a company to revitalize and adapt. The pieces are now clear. A high-stress market, a ticking clock, powerful technology, and nuanced human strategies. What's the final takeaway? We started with a market that seemed unfazed. We now see the hidden risks, record default probabilities, and looming debt maturities. Thriving in this environment requires a multi-layered strategic system, integrating tech, deliberate choices, and sophisticated tactics. The divide will be between those who react to delinquency and those who proactively manage financial relationships. One is catch-up. The other is strategy. The question for every financial leader is this: is your current collection strategy an asset or a liability for the challenges ahead?